Hi everybody, it's Ryan here, and today we're going to be looking at exchange rate systems. The main distinction that we're going to want to look at with exchange rate systems is we either have fixed exchange rates or floating exchange rates. A fixed exchange rate implies that a country will identify another country at which it will guarantee a specified exchange rate. It will then take direct and indirect measures to ensure that the market exchange rate equals the fixed exchange rate. When you think about these different types of exchange rate systems, it's useful to have examples. Saudi Arabia is the best example of a fixed exchange rate system. You can see that here in this chart on the right, where it shows the Saudi Arabian currency compared to the US dollar. Over a period of 10 years, it never changes because the Saudi Arabia government has a fixed exchange rate system versus the dollar. The other type of system that you'll want to know about is a floating exchange rate. This implies that a country lets the market determine the exchange rate and it does not intervene to determine some specified rate. Now, if you really want to get into this, you can see that there are lots of other different types of differentiators amongst fixed and floating exchange rates. Fixed exchange rates can be broken down between hard pegs and soft pegs. At the most extreme end of a hard peg system, you'll see that some countries have no separate legal tender, which means that they don't use their own currency. They use another country's currency. You can see here as well that there are different types of soft peg systems, stabilized arrangements, dirty float or crawling pegs, where the exchange rate might change depending on other indicators, or this other one here, pegged exchange rate within horizontal bands, which means that you allow it to float within certain levels, but then you actually fix it between those different bands. Then down here you've got the floating regimes, some which are floating but then they allow some intervention under certain circumstances, or others which are completely free-floating where there's very, very rarely, if ever, any intervention in the exchange rate markets. Keep in mind that the information on that table is pretty much overkill. You don't really need to know all the different types of exchange rates for this course, just so long as you have an understanding of the difference between fixed and floating exchange rates. And if you really want to dig deeper on this topic, you can actually look up the IMF report on exchange rate systems. To do that, just type into a Google search bar, IMF report on annual exchange arrangements and restrictions. Brings you to this. This takes you through to the report, which you can download for free. And then once you're here, you can look through to your heart's content about what sorts of countries have different exchange rate systems. Going down to table 2, we'll give a list of countries based on what type of currency system that they use. The ones that we're going to find most interesting is we can see that Saudi Arabia is under the conventional peg system. China is listed under a crawl-like arrangement, which is sort of like a dirty float. The important thing to realize, though, is that most of your major economies and major currencies are going to be under a floating or a freely floating system. So looking through here, we've got, Switzerland, the Philippines, Thailand, Turkey, India. And under the completely free-floating system, we've got the United Kingdom, the United States, the Eurozone, which is the EMU, European Monetary Union. Again, it's not necessary to have a very detailed understanding of the different types of systems that countries will have, but just the basic understanding of free versus floating. Governments need to decide how they're going to therefore manage their currencies. As we've seen, most major currencies are free floating. There's no set policy for what the currency should be against other currencies. If a government wants to set its currency to a specific rate against another currency, it therefore must intervene directly in foreign exchange markets. In order to do this, it uses reserves. Foreign currency reserves are foreign currencies held by central banks in order to enable intervention in the forex markets to affect that country's exchange rate. Primarily, they will be US dollar. The US dollar is the world's reserve currency used by central banks around the world to prop up their currency if they need to, but they can use any currency that they want to. A lot of times they will use euros, they'll have British pounds, Japanese yen, even gold bars will be used by central banks as part of their reserves. Here's how we can model how a country can manage its exchange rate using its foreign currency reserves. Let's say for a minute that we're not going to have the pound sterling be a freely floating currency. Let's say that we're going to manage it against some other currency. Let's just say for a minute a now defunct currency, the Deutschmark, and let's say that the exchange rate we're going to be 2.95 Deutschmarks to the pound. And this is how it would look in an exchange rate diagram. If you wanted it to be managed within horizontal bars, which is a type of pegged system, you might say that the maximum that we're going to have is 3.13 Deutschmarks to the pound. The minimum is going to be 2.77. We will not intervene as long as the currency stays within these bands, but if it goes above or below the bands, then we'll have to intervene. So let's say that there's pressure on the pound because maybe everybody is selling their pounds for some reason. Maybe another country has higher interest rates, and so British investors want to invest their money into that country. Maybe all of a sudden British people are importing lots of goods, and so therefore they put their pounds onto the market. This would mean that following the supply shift to the right, we'll have a new exchange rate which is lower than our minimum band, and so therefore the Bank of England, the UK central bank, would be required to intervene to stabilize the currency. They would do this using their foreign currency reserves. The Bank of England would have to directly step in, buying pounds off foreign exchange markets using their reserves in order to push the currency back up to the price at which it is pegged against within those horizontal bands. So this is the diagram for how to graph a managed exchange rate. You'll have your supply, which is equal to your imports or capital outflow, demand, which is equal to exports, which is equal to capital inflow. You would have two horizontal bands here, the maximum exchange rate, minimum exchange rate. If you find that the market exchange rate is below the minimum value, this would mean that the government, or the central bank specifically, must therefore purchase its own currency off foreign exchange markets using its reserves. By purchasing its currency, it will shift the demand to the right until it meets the minimum exchange rate determined by the system. Now, before we get into the advantages and disadvantages of this system, the one thing that we want to highlight, and I think it's quite clear, is that this is an expensive system because it burns through your foreign currency reserves. So in order to understand how it is that currencies can do that, it's useful to then again look at Saudi Arabia again to see how it is that they manage their really hard pegged currency against the dollar. So I really like this graph here because it shows the price of Brent crude oil, and it shows major oil exporters here and their foreign exchange currencies against the dollar and, of course, the oil price. As you can see from most of these currencies, as the oil price falls, therefore, the value of their exports is falling, leading to a shift left in the demand for their currency. And so if it were a completely freely floating exchange rate system, then you would expect the currency to fall in value against the dollar, as it has for Russia especially, and to some extent against Brazil. Now, some currencies will have some sort of pegged system. Nigeria has a bit of a pegged system against the dollar. Kazakhstan had a bit of a pegged exchange rate system against the dollar. But these pegs came under pressure because as the price of Brent crude oil falls, the reserves that the country and central bank would have to use to maintain this peg would become depleted. So the question is, how does Saudi Arabia manage to maintain such a hard peg against the US dollar? The answer comes in terms of how much Saudi Arabia's central bank has in reserves. Saudi Arabia keeps a pegged exchange rate against the dollar. It costs them $7 billion per month to maintain this exchange rate. How can they do that even if the price of their main export is decreasing? Because at the time of this article being written, they had reserves of $644 billion, which was 102% of their GDP. So even though they had a current account deficit of 3.5% of GDP, with this level of reserves, it implies that they would be able to maintain that current account deficit at the current oil price for 30 years just by burning through their reserves whilst maintaining their pegged exchange rate. So even though that Saudi Arabia is a bit of a special case, you can see that pegging that exchange rate with a weak oil price has still led to their foreign reserves in their central bank being depleted over time, although by July 2019, they still had $450 billion in reserves, so they've still got a long way to go before that really becomes a problem for them. It's pretty easy to spot if a currency is being managed against another currency because you can see periods where that currency has a very stable exchange rate. We've already mentioned Saudi Arabia having a completely stable exchange rate against the dollar because of the reasons we mentioned. You can look at this for Nigeria as well. This is Naira that you can buy per US dollar. And over time, as the oil prices weakened, the dollar has gotten stronger against the Naira, but you can see that the Nigerian central bank is trying to keep some sort of peg by the fact that they do have devaluations, but they manage to have stable periods in between those devaluations. This graph shows US dollars in terms of Chinese yuan. You can see that the dollar was very strong against the yuan up until the early 2010s, this was the period in which the US accused China of manipulating its currency to make it artificially weak to encourage Chinese exports. You can see that there were some periods of very level pegging against the US dollar, but in more recent times, it appears that the Chinese yuan has been a bit more responsive to market forces, although, of course, in China, there are still very tight capital controls on who can change currency. So what's going to be really important is to understand the advantages and disadvantages of the different exchange rate systems. The advantages and disadvantages of fixed systems. The advantages are principally price stability. If you have a fixed exchange rate system, as they do in Saudi Arabia, the price of your imports are going to remain stable. So your citizens are not going to see big changes in the price of imports based on the currency because the currency never fluctuates. Another advantage is discipline. Governments and countries know that the exchange rate will not adjust if they let prices get too high. This gives them an incentive to keep prices low. In particular, having a fixed exchange rate system is a signal to the rest of the world that you're going to be serious about tackling inflation, because if you were on a floating exchange rate system, you could rely on the exchange rate to change, which would then change the price of your products and make them more competitive on global markets, rather than doing the hard things, which is the internal devaluations, which are necessary to maintain price stability. The disadvantages of a fixed system, as we've said before, the need to hold a high level of reserves, loss of control over domestic monetary policy. Because interest rates affect exchange rates, if you have a fixed system, it is not possible to set your interest rates in order to respond to changes in your economy. You have to fix interest rates in order to make sure that you can maintain the stability of your currency. No automatic balance of payments adjustment. In theory, if a country is running persistent deficits in their current account of the balance of payments, which means their imports are always higher than their exports, in a free-floating system, because imports are higher than exports, this suggests that supply is greater than demand. This suggests a situation where there's excess supply. There would therefore be downward pressure on the exchange rate, and it would continue to depreciate until exports were more competitive, imports were more expensive, and so therefore people would be exporting more, importing less, and the balance of payments problem would be corrected. Possible attacks from currency speculators, which is hot money. If you have a fixed exchange rate system, that means that your central bank is committing to buying their currency off of Forex markets at an agreed price. If speculators believe that this price is too high, they can short sell your currency, which the central bank would have to continue to defend, effectively putting your central bank at war with currency markets and speculators that are going to try to take you down. The advantages and disadvantages of a fixed exchange rate system all get a bit theoretical, and I find it's best to put it into the context of when the UK was on a fixed exchange rate system within horizontal bands, and then when we fell out of that system on Black Wednesday, the 16th of September, 1992. We'll have a look at the events of Black Wednesday and how the Bank of England was fighting against the speculators in another video. That's all for this content. Thanks for watching. I hope you found it useful. If you did, please make sure that you give it a like and subscribe to this channel for more interesting economics content.